Alright, so in this video I wanted to talk about the risks of selling options, or more specifically, the risks of letting your option trade go to expiry and hoping that it expires worthless. So let me explain the scenario. So on November 4th, when Biogen jumped up to 355, a trader sold a put spread at 300-295 for November 6th expiry. So the same week expiry, sold a put spread at 300-295. So for those of you that don't know what a put credit spread is, let me explain it quickly. So a put credit spread is an option strategy. It combines two puts, same expiry, but two different strikes. You sell one of them, you buy the other one. The difference between both strikes determines what your maximum loss is. So when you sell a put credit spread, the way you win on this trade is if the stock stays above your short strike come expiry. So the expiry in this case was November 6th. This trader sold the 300 put, so he wins as long as Biogen stays above 300 come November 6th. So when he placed this trade, Biogen was trading at around 355. So say when he sold the 300 put, he collected, let's say, I don't know, $10 from selling the put, but he paid $9 to buy the 295 put. So the net difference is a credit. Collected 10, paid 9. So that's a $1 net credit. So what's the maximum loss on this trade? Well, the difference between both strikes is 5, but he collected a credit of $1. So the max loss is $4. When does max loss occur? Max loss will occur if the stock is trading below 295 come expiry of November 6th. Why is max loss always $4? Because regardless where Biogen is trading at, if it's trading at 280, 270, 260, the value of this put option, the value of the long put, will always be $5 less than the value of this short put, because this strike of 300 is $5 higher. So let's say Biogen is at 280 at expiry. Well, then this put option is going to be worth $15. 295 minus 280 is 15. This 300 strike will be worth 20. So the difference, so the net credit or the net debit will always be $5, regardless where Biogen is trading at expiry below 295. So the max closing price of this spread will be $5, but since the trader collected $1, then his max loss is $4, which is the difference. But if Biogen is trading above 300, these put options are going to expire worthless. They're worth $0. So you can either buy them back for very cheap. So you can buy the spread back for maybe 10 cents, 15 cents on the expiry date, or could let it expire worthless. So then he would win $1 on this trade. So here's what happened. When Biogen flew to 350, this trader sold a put spread at 300-295 strikes. This was November 4th and had 2 days to go. The next day, November 5th, Biogen was trading at around 326, 332 in that range. So still above his short strike of 300. So it was trading at 326. So it didn't do anything. So here's where this trader lost 21,000, and it wasn't even his fault. And there wasn't even anything he could have done to avoid it. So Friday, November 6th, which was expiry day, the shares halted. So you couldn't trade the shares, you couldn't trade the options on that day. And as you can see, that's why you see November 5th over here, but then there's nothing for November 6th. It jumps to November 9th. There was no trading activity for November 6th. So on Friday, the trader is faced with a stock that can't be traded. He's got an open options trade on it. The last price he saw was on Thursday, stock being above his short strike of 300. He has no way of knowing what the stock is trading at because the shares halted. So there is no trade. So this is Friday, November 6th at expiry. He wants to close the trade. He can't even close the trade because shares halted. Now, according to yesterday's price, Thursday, November 5th, the trade looks like a winner because it's trading at 330, while his short strike is 300. Even the OCC issued a statement, Biogen trading halt expiration pricing considerations. So the OCC strongly recommends clearing members contact all holders of expiring Biogen options to apprise them of the contents of this memo. So for purposes of calculating a price for use in expiration processing on November 6th, OCC will use the last available Biogen price of 328.9 from November 5th. So an option holder who intends to exercise an option before expiration must give exercise instructions to his brokerage firm before the firm's cutoff time. So when I was saying that the max loss is $4, it's because by buying this 295 put, you're buying it for protection basically. In case the stock drops way below 295, you're not affected by that because this put option here is for protection. So on Friday, November 6th, the trader sees that the stock is not being traded and the last traded price was around 328, 326. What does he do? Can't close his trade. It looks like it'll be a winner. It looks like it'll expire worthless. But here's the risk. The risk is on Monday, the shares could end up way below 295. And in fact, what happened, the shares ended up trading at around 230 on Monday. So even with the shares halted on Friday, you're still able to exercise options. So what happened is the buyer of this put option, so this trader sold this put option and bought this 295 put option. So the buyer of this put option ended up exercising it. So if the buyer exercises a put option, that means he is selling shares at that strike. So if he is selling shares at that strike, the trader who sold this put option is going to end up buying shares at that strike. So what ended up happening on Monday, the trader found 100 shares of Biogen at a 300 strike in his account. Now, sadly, the trader had done 3 contracts of this trade. So ended up with 300 shares of Biogen at a $300 strike. So that's $90,000 came out of his account to buy shares of Biogen at a $300 strike because someone exercised their put option. But since it was Monday, his put option, his long put option that's used for protection, expired worthless. Since he's the buyer of this put option, he's the one who's supposed to exercise it. Now, he didn't exercise it because he didn't know what the price was, because of course no one knew what the price was, because shares halted on Friday and there was no after-hour trading either for that stock. So someone, out of precaution, exercised this put that was sold by this trader. This trader, not knowing that he got assigned on his short put, and there was no way of knowing unless the broker is supposed to notify him that his short put got assigned. Now the question is, when does the broker get notification that a short put got assigned? Now on Friday, he can't exercise his 295 put out of precaution because he doesn't know what the stock will be trading at on Monday. The stock could be at 326 on Monday. If he exercises his 295 put, that gives him the right to sell shares at 295. So if he's short shares at 295 and the stock is in the 300s, then he's already losing money. So there was really no way for this trader to close the trade on Friday, and there was no way of protecting himself by exercising the put because he doesn't know what the stock is trading at. He can't even do it out of precaution. I think the only way is if the broker got instructions for this put to be assigned or exercised, then the broker should have taken action and exercised this long put automatically for protection in this trader's account. Because instead, the stock ended up opening on Monday at 230 while this trader owned the stock at 300. So he's down $70 per share and he had 300 shares. So that's $21,000 that he was down. Obviously got a margin call. Didn't have much choice. Either he keeps the shares and waits for the stock to come back up, but then he's unable to make other trades because he's in a margin call. He could sell covered calls on them, but that's capital being tied up, not being used to place other trades that he's normally more profitable on. So what he had to do, he ended up closing the trade. So he ended up selling the shares on the market for 230 when he bought them at 300, because by selling that 300 put and by getting assigned the 300 put, it's like he ends up buying the shares at a $300 price, and the next day the stock's trading at 230. So he's down $70 already. Because his account size can't afford it, he had to close his position to get out of the margin call and live to trade another day. Now, a few days later, Biogen ended up trading almost 250, so probably would have taken a small loss if he held on to it a little bit longer, maybe $15,000 loss. But of course, you don't know where it's going. Plus, with a margin call, you have a few days to cover your account either by depositing more money or by liquidating some positions. So what's a lesson to be learned here? Now, the scary part is I don't see anything. I don't see how this trader did anything wrong. Besides maybe entering a put spread when the stock jumped this high, maybe it's not a good entry. But holding to expiry with the intention of closing it on the same day is not a mistake. And then the shares get halted on Friday. That's not something anyone can predict. And yes, you have the long put for protection in a put spread, but you don't know what the stock's going to be trading at. So why would you exercise a put option that could end up going against you if the stock is actually trading above your put option that you're exercising? So in my opinion, there was really nothing the trader could have done after the trade was placed. The only thing I see is maybe the broker could have exercised the shares automatically when they got instructions that the short put would get assigned, because there was no after hour trading either, so no one really knew what the price was trading at. Even the person who bought the put option, the 300 put option, and exercised it, did not know what the price would be trading at on Monday. But they just took precaution, decided, let me just sell my shares at 300 just in case. even if I can see that on Thursday it's trading at 326, I don't know what's going to be trading at on Monday. So let me take precaution, exercise the 300 put that I bought and sell my shares at 300, which ended up affecting this trader who sold the put credit spread. Ended up with 300 long shares at a 300 strike with no chance of exercising his put option for protection. Because if he were able to exercise his 295 put for protection, he would have lost $4 times 3, would have lost $1,200 instead of $21,000. I'm thinking another way maybe this trade could have been avoided is if you only trade naked puts instead of put spreads. Because when you do a spread, you could end up trading several contracts. And if something like this happens and you get assigned, well, it's more than your account size can handle. So you're forced to close your position for a loss. But if you did a naked put at 300, you would only be able to do it if your account can afford 100 shares of that stock at 300. So even if this happened, but you only had the naked put at 300, and then on Monday the stock ends up at 230, well, then you could roll your put until the stock comes back up and your account size can afford it. But then of course you're making less return on capital. So honestly, this story really scared me because it could happen to anyone. It could happen anytime, and it's no one's fault. If it was someone's fault, then you could learn from the mistake, but I don't even see a mistake besides maybe trading biotech stocks or even pharma stocks. What scares me the most is I was actually in this trade, but I had a 200 put, 200, I had a 205, 200 put spread, and I closed it when the stock jumped on November 4th. So I got out of this trade when the stock jumped. But imagine I didn't get out of this trade and I decided to hold it to expiry just so I don't have to pay commissions to close the trade. Now in my case, I had the 205 short put. So if that happened to me and I got assigned, because the stock was trading at 230, that would have been beneficial for me because I would have owned shares at 205 and the stock's trading at 230. So that would have been quick profit. But if my short strike was anywhere above the price on Monday, which was around 230, then it would have been a dangerous trade. So I still say it's important to close your trades before expiry. Don't let them expire worthless. If you have to pay a few pennies just to close a trade, then it's definitely worth it. Although this has nothing to do with what happened in this trade, but definitely having the mentality of closing your trades will probably avoid a lot of unexpected surprises like this one. Second thing I'd add, maybe add more time to the trade, maybe not do weeklies, maybe do 30 days. So even if on Friday something like this happened, at least you still have time to manage a trade. Although if you had the 300 put and the stock drops to 230, you would still get assigned anyways. But at least you still have that long put that hasn't expired yet, and you could use it for protection. So this trader had the November 6th expiry, and that's when this incident happened. Let's say he had the November 20th expiry. So his short put would have gotten assigned anyways. So he would end up with 300 shares at a 300 strike, but he still owns the 295 put. So then on Monday, he could exercise his 295 put or even sell it right away because his 295 put's going to be worth $70, $80, if not more. In fact, he probably could have made money on his long put because there's still time value on his long put. So going back to the trade. So let's say he had the November 20th instead of the November 6th expiry. This short put would have gotten assigned because someone exercised it. So he would end up with 300 shares of Biogen at a $300 strike at a $300 price. The stock is trading at 230. So on the shares, he's down $70. But now his long put of 295 has intrinsic value of 230 minus 295. So it's got $65 of intrinsic value, his long put, at least. That's the intrinsic value. But it also has extrinsic value. It's got time value because the expiry is November 20th. It still has 3 weeks to go. So his long put is worth more than $65 for sure. It's not going to have that much time value because it's deep in the money. His 295 put will be deep in the money, but it's going to have a bit more time value. So he's going to end up losing less than $4 per spread on this trade if he had taken a further expiry. So maybe that's another way of avoiding these surprises that are completely out of your control. So really let me know what you think in the comment section below. If you've experienced something like this, if you've heard stories similar to this, who do you think is to blame in this? Should the broker have done something, advised them that his short put got assigned? Is it even an information that the broker knows on Friday? Because he could still exercise his long put even after hours, but he would have to know that he needs to exercise it. He would have to know the price. He doesn't know the price. The broker doesn't know the price, but the broker could possibly know that his short put got assigned or that they received instructions to assign that put. All right, so if you have any questions, leave them in the comment section below. You can open an account with Questrade to trade on the stock market. Use my referral link below to get $50 in free trades. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.